What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. With the Federal Reserve hiking interest rates for the first time in more than 3 years, we're starting to see the unraveling of what is increasingly looking like a pandemic tech bubble. One of the most obvious examples of this is the video streaming giant Netflix, which was previously considered to be a Nasdaq stalwart. Since the beginning of 2022, the stock has lost 64%, wiping out more than $100 billion of market cap on the back of 2 disastrous earnings reports. Perhaps the single biggest loser from Netflix is billionaire hedge fund manager Bill Ackman. In January, he bought about $1.1 billion worth of Netflix shares after they reported a disappointing earnings result. This made up almost 10% of his entire portfolio. At the time, he said the company had enormous growth potential, a best-in-class management team, and was on the cusp of achieving massive economies of scale. He said that short-term investors were unfairly pushing the price down and giving long-term investors like him an opportunity to buy in at an extremely attractive valuation. However, within just a few months, he did a complete 180-degree U-turn. He dumped his entire position, incurring a $400 million loss for his investors. On April 20th, Netflix disclosed that they had lost 200,000 subscribers in the first quarter, and are on track to lose 2 million in the second quarter. This marks the company's first quarter of negative subscriber growth in more than 10 years. Founder and CEO Reed Hastings blamed this disastrous performance on password sharing, as well as increasing competition. In this video, we'll look at why Netflix is losing subscribers, why Bill Ackman got this investment so wrong, and what are the company's prospects going forward. But first, quick pause from our sponsors over at Policygenius. If someone relies on your financial support, whether that's a child, aging parent, or even a business partner, you need life insurance to give you peace of mind. Typically, life insurance gets more expensive as you age, so it's smart to get a policy sooner rather than later. But unless you're a professional accountant, it can be very difficult to compare the pros and cons of different policies. That's where our sponsor Policygenius comes in. Policygenius is your one-stop shop to find and buy the insurance that you need. You could save 50% or more on life insurance by comparing quotes with Policygenius. Their team of licensed experts will help you understand your options and apply for the policy that you choose. The Policygenius team works for you, not the insurance companies. You can trust them to offer unbiased help and advocate for you at every step until you're covered. Importantly, they charge no extra fees and do not sell your data to third parties. Click the link in the description or head to policygenius.com/wallstreetmillennial and answer a few questions. In minutes, you can compare personalized quotes from top companies to find your lowest price. And now back to the video. As the most popular streaming service in the world by a pretty large margin, Netflix needs no introduction. They spend over $10 billion a year on original content, including critically acclaimed hits like Stranger Things and Squid Game. You can get thousands of movies and TV shows from all over the world for $10 a month, which is a fraction of the cost of cable TV plans. As the first mover in this disruptive category, Netflix saw explosive growth, increasing its subscriber base from 40 million in 2014 to more than 200 million in 2021. It became one of the most popular stocks on Wall Street, reaching a market cap in excess of $300 billion. Netflix was a trailblazer, winning Academy Awards, gaining millions of new subscribers every quarter, and it looked like they were on track to take over the world. So what happened? For the first quarter, they reported a net loss of 200,000 subscribers, which was their first quarterly loss in 10 years. This isn't quite as bad as it seems. In response to the Ukraine invasion, Netflix shut down their service in Russia, which cost them 700,000 subscribers. Had it not been for this, their 200,000 subscriber loss would actually be a modest 500,000 gain. But it looks like things are only going to get worse from here. They gave guidance saying that they are currently on track to lose 2 million subscribers in the second quarter, which would equate to about 1% of their subscriber base. This might sound surprising. Based on the quality and quantity of their content, they only appear to be getting better. In 2021, their original content won 7 Oscars, the most of any production studio. Their 2021 hit show Squid Game was the single most watched show in the platform's history, garnering 1.6 billion viewing hours. So why are they now bleeding subscribers? According to CEO Reed Hastings, there are 2 reasons: password sharing and competition. I'm sure that either you or someone you know watches Netflix using somebody else's username and password, be it a family member, friend, or even just acquaintance. They estimate that 100 million people watch Netflix using a shared password from somebody outside their immediate household. This is about 50% the size of their total paid subscriber base. In the past, they strategically allowed password sharing. The idea was that if someone starts watching Netflix with a shared account, they'll get to see how great the platform is and will eventually pay for a full subscription themselves. And at the time, Netflix was growing so much that they didn't need to worry too much about a few people sharing passwords. But now with their subscriber base melting, their perspective has changed. Netflix will start charging users a $2 to $3 fee for anyone who shares their password with someone else outside their immediate household. They will compare people's IP addresses to determine whether they are in the same household. This crackdown is currently being tested in 3 Latin American countries and is expected to be rolled out globally by the end of this year. Even if they are successful with their password sharing crackdown, this will only get them $1 or $2 billion of incremental revenue. That's peanuts compared to the $200 billion of market cap that they lost since their peak just a few months ago. Clearly, password sharing isn't the main issue. There's something else going on too. A much bigger issue is a tidal wave of new competition coming onto the market. In the past, Netflix was a near monopoly in streaming. The legacy media companies avoided launching their own streaming services in fear of cannibalizing their cable TV businesses. But over the past few years, the situation has changed drastically. Today, Disney+, HBO Max, NBC's Peacock, and Viacom's Paramount Plus are all spending billions of dollars per year on new content and aggressive marketing. Today, the average American household uses 8.8 streaming services, with the majority of them being free ad-supported platforms like Viacom's Pluto TV or NBC's Peacock. But they also use paid services such as Netflix and Disney+, with the average household paying $32 per month. While that's still far below cable TV, which can cost upwards of $70, it is getting expensive for consumers. While Netflix used to be the only game in town, consumers now have choices, and especially with high gas prices and other inflationary pressures, many people see that they're spending too much on video streaming and need to cut back. At the same time that consumers are pulling back, Netflix's production costs are skyrocketing. Netflix used to pay Disney, NBC, Warner Media, and others for rights to show their content. But now that these companies have their competing streaming services, they're slowly pulling back their content. They've been making up this difference by massively increasing their production of Netflix originals. But that is very expensive. Over the past 5 years, their content spending has more than doubled from $7 billion to $17 billion. This was fine because they were increasing their subscriber base at a similar rate to be able to maintain profitability. But with their subscriber count now decreasing, the year-over-year increases that we've seen in content spending appear increasingly unsustainable. They recently laid off their director of original animation along with most of his team, and cancelled multiple shows under development in an attempt to conserve cash. But with increasing competition, the lack of investment may further accelerate the deterioration of their subscriber base. With so much new competition coming online, Netflix's decline looked inevitable in hindsight. Why would anybody have expected anything else? But like a deer in front of headlights, billionaire investor Bill Ackman went all in on the stock just 3 months before their subscriber growth inflected negatively. In January of 2021, Netflix reported disappointing earnings results for the fourth quarter of 2021. While they beat on the top and bottom lines, they said that they expected net global subscriber additions of just 2.5 million in the first quarter of 2022, which would be their slowest growth rate in many years. This announcement caused the stock to lose more than 25% of its value in a single day. Ackman had long followed Netflix's success over the years. He's a big believer in the shift from cable TV to streaming, and has been waiting for a good buying opportunity to build a position in the stock. That buying opportunity was delivered to him on a silver platter. He bought $1.1 billion worth of Netflix at a cost basis of about $360 per share. He immediately sent a letter to his hedge fund's investors explaining the decision. He said that the company still has enormous growth potential. They just had one bad quarter with subscriber growth slightly missing expectations. But if you take a long-term view like he does, the megatrend of video streaming is still intact, and Netflix will continue to be the biggest beneficiary. Most analysts on Wall Street were expecting 2.5 million new subscribers per quarter going forward. When Reed Hastings said that they were on track to lose 2 million subscribers, Bill Ackman was just as shocked as everyone else. In addition to their password-sharing crackdown, Netflix is planning to launch a cheaper ad-supported tier to win back cost-conscious consumers. Very shortly after the earnings results, Ackman sent another letter to his hedge fund's investors. He said that given Netflix's challenges to grow its subscribers, the range of potential future outcomes for the stock are too diverse for him to predict. So he decided to dump the whole thing for a $400 million loss just 3 months after buying it. Ackman is supposedly a legendary investor whose hedge fund manages $13 billion. How could he have gotten this trade so disastrously wrong? There are a few reasons. Ackman made his career as an activist investor. One of his biggest successes was buying a stake in Canadian Pacific Railways and replacing the CEO that increased the company's efficiency. This caused the share price to triple within a couple years. He also had some very successful trades around the 2008 financial crisis with his well-timed short position against the financial company MBIA. Despite his successes, he almost never invests in technology companies, as these are largely outside his area of expertise. The letter that he gave explaining his Netflix thesis was very short, less than 2 pages long. It doesn't look like he did a ton of research on unit economics or the effects of new competition in the space. It looked like a very impulsive decision to buy the stock right after earnings. Ackman says that he himself is an avid watcher of Netflix, and this may have played a role in his investment decision. But if you thought the stock was undervalued when you bought it at $360, how can you be selling it at $220 just a few months later? Ackman said that one of his key learnings from past mistakes is to act promptly when he discovers new information, which runs contrary to his initial investment thesis. It's often better to cut losses and look for better opportunities instead of bag holding a position and hoping for a turnaround. Multiple times, he has taken his hedge fund to the brink of failure by doubling and tripling down on positions when they started moving against him. This happened with his long position in the failing retailer JCPenney, as well as the borderline fraudulent pharmaceutical company Valeant. And perhaps his single most disastrous position was his multi-year short-selling crusade against the multi-level marketing company Herbalife, which resulted in over $1 billion of losses. With the shocking deterioration of Netflix's now negative subscriber growth, Ackman realized he's in over his head and has no idea what will happen to the company in the future. I personally don't have any position in Netflix stock, but it does look like the sell-off got a bit ahead of itself. Unlike many other high-flying tech stocks, Netflix is profitable and currently trading at less than 20 times its trailing earnings per share, which is a slight discount to the S&P 500. And while they certainly have problems with increasing competition, they are the premier global streaming platform by far, with almost 40% of survey respondents saying that they have the best selection of original content. While the exponential growth from the early years are now clearly behind them, nobody can argue that Netflix has built a world-class brand and is here to stay. Alright guys, that wraps it up for this video. Do you think Netflix's share price decline is justified? Did Bill Ackman make a mistake by dumping his entire position at the lows? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.